Ladies and gentlemen, good day and welcome to the JG Chemicals Limited Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Ms. Prachi from Phillip Capital. Thank you. And over to you, ma'am.
Good evening, everyone. On behalf of Phillip Capital Private Client Group, I welcome all of you to Q2 and H1 FY26 earnings conference call of JG Chemicals Limited. Before we begin, I would like to mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management beliefs as well as assumptions made and information currently available to management. Audience are cautioned not to place any undue reliance on this forward-looking statement in making any investment decision. The purpose of today's earnings conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Today from management team we have Mr. Anirudh Jhunjhunwala, Managing Director and CEO, Mr. Anuj Jhunjhunwala, Whole-Time Director and CFO, and Mr. Amit Agarwal, General Manager, Accounts and Finance. I now hand over the conference to Mr. Anirudh for his opening remarks and then we will open the floor for question and answer. Over to you, sir.
Thank you. So good afternoon everybody and a very warm welcome to JG Chemicals Limited second quarter FY26 earnings call. I would like to thank each one of you for joining us today. For those who may not be aware about the company too much and may be new to the numbers, let me begin with a brief overview of the company, followed by our performance for the quarter and the half year and some key operational highlights. To begin with, JG Chemicals Limited is India's largest zinc oxide manufacturer and the country's leading zinc recycling company. Our product caters to a wide range of industries including rubber and tire, pharmaceuticals, ceramics, agriculture, paints and coatings, electronics, batteries and also specialty chemicals. We are well diversified geographically with approximately more than 200 domestic customers and also we service approximately 50 international clients exporting to more than 10 countries worldwide. We cater to top 9 of the 10 global tire manufacturers and also to the top 11 leading tire companies in India. In a recently conducted internal survey, the company noticed that it has more than 95% repeat order percentage, which is very encouraging for us and speaks about our deep-rooted relationship with customers and the confidence that they place on us. Our manufacturing infrastructure includes plants located in the state of West Bengal and Andhra Pradesh with a combined capacity of nearly 70,000 metric tons of zinc chemicals. We offer roughly 80 specialized grades of zinc oxide to cater to highly customized application needs. In the zinc oxide business, one size fits all, one grade fits all does not work. Our Naidupeta facility is the only IATF certified zinc oxide plant globally. It is also WHO GMP approved and holds IP, BP, USP and the European Pharma certification, enabling us to serve regulated industries such as pharmaceuticals and cosmetics with the highest quality standards. Sustainability and recycling continue to be an integral part of our operations. As India's largest zinc recycling company, our processes enable significant reduction in carbon and energy consumption, carbon footprint and water usage. We continue to evaluate opportunities in advanced recycling and energy efficient technologies all the time. Alongside this, we are also currently working on developing specialized and customized products tailor-made to the specific requirements of key customers. This enhances the attractiveness of partnering with JG and in the long term strengthens our proposition as a preferred supplier for high-performance applications. We are also seeing encouraging development in the domestic market, particularly with the growing presence of homegrown brands, especially in the healthcare, cosmetics, and the personal care segment. These emerging brands are increasingly looking for high-quality zinc oxide in the market, and this trend is opening up meaningful and new opportunities for us in the non-tire and the non-rubber applications. In parallel, the company is also working currently on developing a new recycled rubber product to increase the content per tire supplied to our customers. We have already spoken about this before. This project is moving very well, and trials are expected to begin soon in the coming Q4. We are also expanding proactively into non-rubber applications and aim to increase the non-rubber share from the current 15% to over 30% in the next 4 to 5 years. Having said this, after a flat Q2 where GST rate implementation, the new GST rate implementation pushed purchases, the current Q3 is seeing good demand. The tire industry in general is expected to grow well in the coming years, and the company is very well positioned to capture this growth also. As many of you would recall, we had announced the Dahej greenfield expansion in the previous quarter. I would like to briefly touch upon the progress during the current period because this project remains a very important part of our long-term growth strategy. This 40,000 metric tons per annum zinc chemical facility at Dahej is progressing as planned. Phase 1 of the facility is expected to be commissioned in the H1 of FY27, and once stabilized, the plant has the potential to generate revenues over 900 crores. Dahej will significantly strengthen our presence in Western India and deepen our reach in the ceramics, specialty chemicals, agro, and also the tire business. Our current capacity utilization in our existing plants is around 70% of the achievable capacity, and we can easily take this up to about 85% without much constraints. Hence, our spare capacity at Naidupeta currently remains adequate to service anticipated customer demand for the upcoming fiscal, ensuring continuity with our customers until the Gujarat and the Dahej facility becomes operational. I am also happy to mention here that the company recently paid a dividend of Rs 1 per share for the FY24-25. We expect to continue the dividend payout in future years. Having said this, I would now like to hand over the call to our CFO, Mr. Anuj, who will take you through the financial performance for the quarter and the half year, along with some operational updates. Over to you, Anuj.
Thank you. Good afternoon, and once again, welcome everyone on the call. I will now take you through our financial performance for the second quarter and first half of the financial year, followed by some operational and business updates. For Q2 FY26, our consolidated revenue from operations stood at approximately 220 crores, representing a year-on-year growth of around 4%. EBITDA for the quarter was at 21.9 crores with an EBITDA margin of 9.94%. Profit after tax stood at 15 crores, resulting in a profit after tax margin of 6.81%. The very marginal 0.7% decline in EBITDA margin during the quarter was primarily due to the consumption of higher cost inventory arising from shipping delays in the previous period. This was a temporary factor, and we are already seeing normalization. With logistics stabilizing and zinc prices showing improvement, we expect margins to be much better in the coming quarters. For the first half of FY26, consolidated revenue from operations stood at 438 crores, a growth of 6% year-on-year. And EBITDA for the first half was 45 crores with a margin of 10.29%. Profit after tax for H1 stood at 31 crores, translating into a PAT margin of 7.16%. The GST reductions in September supported a pickup in the automobile activity, which we witnessed in the last few weeks. This will help the tire segment immensely. We continue to see steady traction across non-rubber applications as well, such as pharmaceuticals, cosmetics, ceramics, specialty chemicals, and certain other special applications. Input cost conditions and logistics have begun to stabilize, which provides better visibility on the cost environment going ahead. With this, we can open the floor now for the question and answer session.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Asmita from Electrum Capital. Please go ahead.
Hello, am I audible?
Yes.
Yes.
Thank you for the opportunity, sir. Just 2 questions from my side. Is the company evaluating any opportunities for inorganic expansion in the near to medium term?
And what's your second question?
So over the past few quarters, we've seen that the EBITDA margins are around the 8 to 9% range. So when can we anticipate this returning to the 10 to 11%? That would be from my side.
Sure. So I'll address both your points. The first thing was on the inorganic expansion. As we mentioned before, the company continues to evaluate different opportunities which come its way. We are working on the opportunities which are there today. And as and when the timing is right, we will announce it to the markets as per the regulatory requirements. Now, on the EBITDA margins, we've always maintained that the steady-state EBITDA margins in our core manufacturing business of zinc oxide is in the 10 to 11% range, and we expect the margins to inch up to about 13 to 14% on a consolidated level as the share of non-rubber applications increase in the overall revenue stream.
And what would be the guidance for EBITDA margins for the year?
As I mentioned, the EBITDA margins are currently in the 10 to 11% range, and we expect these to inch up to the 13 to 14% range in the next 2 to 3 years. When the share of non-rubber applications increases from where it is to where we intend to take it to about 30%.
Sure. Okay, sir. Thank you.
The current EBITDA margin for the H1 is 10.28 and not 8 to 9%, if you may just have a look at the numbers.
No, I was talking about the Q2 and Q1.
And even the Q2 number would be at approximately 9.92%.
Right.
The EBITDA margin.
Thank you.
Thank you. The next question is from the line of Aman Singh, an individual investor. Please go ahead.
Good evening, sir. Thanks for the opportunity. So my question is, what is the outlook that you are expecting in the tire industry going forward?
So with the tire industry, as you mentioned, even in the last quarter, the tire industry is expected to grow between 7 and 8% in the next couple of years. That is what the projections were for certain independent bodies. And that time we were not aware of the GST cuts which were going to happen. Now with the current GST cuts, etc., the tire demand seems to be quite good, and we are witnessing a good quarter demand. And hopefully this will translate to a certain slightly higher number than what we had envisaged of 7 and 8%. So we expect a healthy growth in tire business. A lot of our large tire companies have announced capex also. They are increasing capacity. I think overall in India, if the economy does well, tire is one of the biggest beneficiaries because everything in the economy that moves through the tire. So we are expecting a robust growth in the tire business in the next couple of years.
Okay, understood. And my next question is, so what are the key challenges faced in handling the zinc scrap? Is your technology in-house or purchased, and how does it compare with other countries?
As far as the technology for processing scrap is concerned, this is 100% an internally developed technology. It's an IP that is internally owned, and this has been done over the last 2 decades of trials, errors, learnings, and continuous R&D. Now, as you would be aware, just to give you an idea, zinc scrap comes in different forms, sizes, impurity profile, purity profile. So it is not very easy for a newcomer or a plant which has not handled this kind of scrap to suddenly switch to scrap and produce the same quality over and over again. So this is a technology which has been developed 100% by us through a lot of years of R&D and trials. and also closely working with our customers. So this is very different from where, there are producers who would blend virgin zinc with scrap to arrive at a particular quality. That usage is not so difficult, but if you try to manufacture those grades from 100% scrap, it is not an easy business to do.
Okay, sir, understood. And my last question is, currently we are seeing an uptrend in the price of all the commodities like zinc, copper, etc. Does this have an impact on the company's business?
So, as we've always mentioned in the past, that the company carries a core inventory of zinc in its portfolio, and any increase in the prices of zinc obviously helps in the overall margin profile going ahead.
Okay, sir, understood. Thanks for the opportunity and good luck for the future.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Jay from Ilios Financial Services. Please go ahead.
Hello, am I audible?
Yes, please.
Yeah. So thank you so much for the presentation and guidance. I wanted to understand more about the raw materials. So as I understand, 90% of the raw materials is secondary zinc. So I wanted to understand how much in percentage is imported and is sourced domestically.
So as you rightly mentioned, most of the material that is zinc scrap is called secondary zinc. Currently, our domestic to import procurement would be roughly 50-50.
50-50. Okay. And is there any change in strategy going ahead regarding the import or export?
So the company is flexible on this as the opportunity is there in the market. If there is a price arbitrage available in the market, the company has the right to switch from domestic to international or vice versa. So we take advantage of any price arbitrage available in the market and use the same to the advantage of the company.
Got it. Thank you, sir. I had one more question regarding, as you had mentioned, like there are not more than 50 domestic producers of zinc oxide in the country. So I wanted to understand how does having a pricing advantage in terms of your recycling technology and usage of scrap materials, how does that help you gain a competitive advantage over your peers? Like if I could get a number of say a percentage of price reduction you provide to your customers compared to your peers.
Can you repeat the last part of your question, the last couple of lines what you said?
I asked if I could get a rough pricing estimate, like the reduction in price you provide to your customers since you have this recycling technology that others don't.
So, okay, fair enough. So, coming to the point, number one, as you mentioned, there are a number of zinc oxide producers. Bulk of them happen to be very small producers who are maybe in the range of about less than 5,000 tons per annum. So those kinds of producers actually do not qualify to supply to some of our customer profile, which includes leaders in the fields of whether it is tire, whether it is pharmaceuticals, whether it is cosmetics, whether it is ceramics. So you need to have a certain scale and standard to be approved by these vendors. Vendor approvals in our business, especially in the tire business, often ranges from about 5 to 7 years for a vendor to be approved. And they do not like to approve vendors who are below a certain size and scale, because those size and scales cannot give you complete control over quality and productivity and consistency for that matter. So when you move up the value chain and when you are servicing clients who are blue chip in their city, there is no reason for the company to actually give a discount to the smaller people. Rather, it's an IP which the company has developed. The company maintains very strict control and adherence to quality standards, to consistency. So there is no reason for a discount in the market. I mean, we would like to believe that today, dealing with JG or dealing with a producer of our size and capacity and control is an advantage for our customers, and they would not be looking for a discount over the competitor on it.
Okay. Got it, sir. And are there any steps being taken to protect this IP, as you said, from getting distributed?
So this is a process of continuous evolvement. As I said, this is a effort of 2 decades of work which the company has put in. Now, today for this technology, for somebody else to do this, number one, he has to have the scale to do this because he is dealing with scraps and scraps are not homogeneous. So if you are looking to manufacture grades from only scrap, you have to have that much quantity and that much variety of scrap in your plant. And you can only have that if you have a size. So in some sense, our IP is also internally protected by the size that we have. And this size is continuing to grow year and year. So that is one of the key factors which does not allow anybody else new in the market to come and have a technology to blend various scraps to produce the finer grades of zinc oxide.
Okay, got it, sir. Thank you for being patient with my questions. Thank you.
Thank you.
Thank you. The next question is from the line of Dhruvin from SKP Securities. Please go ahead.
Hi, sir. So, I just wanted to understand from a basic angle that the zinc prices which have increased significantly, I believe, from the lows of April compared to now. So, zinc oxide also being a derivative of same must have increased in prices. Having said that, then why are our H1 margins under pressure like this, despite the zinc prices rising?
So the zinc price, as we have always maintained, that the company is basically agnostic to zinc prices. Higher or lower zinc prices does not make a difference. The difference it makes is only on the core inventory that the company carries, and this core inventory obviously gets affected if the zinc prices falls or rises. Now, as you rightly pointed out, the zinc prices have rallied quite a bit, but this rally has basically been only in the last 1 month. So from April to mostly July and August, the rally was not that much. In fact, in the first quarter, zinc prices had actually dropped. But we were able to protect our EBITDA because one of the reasons which Mr. Anuj also mentioned, that there were certain shipping delays. So high cost material of the previous quarter actually landed up in the Q2. That's why you would see a relatively flattish to slightly muted EBITDA levels in the first 2 quarters. But as you rightly pointed out, zinc prices have recovered very sharply in the last 3 to 4 weeks. So this obviously augurs well for the company in terms of oxide pricing and also from the core inventory that the company carries. So the benefits of this will obviously improve going forward.
Okay, sir. And any updates with finding any, I don't know, if we can call it like a manufacturing base or something that we were looking at abroad to compete with respect to exports or something?
So a couple of things. One is, as far as exports are concerned, the company is consistently pushing for more and newer export markets. Our clients who have been with us for a long time in India have also operations abroad. So those are our immediate targets, and work is going on well over there. And the company is continuously being able to, get greater penetration in the export market. As far as global opportunities for expansion is concerned, as Mr. Anuj mentioned, we are working on some opportunities. As and when the time is right for the announcement, we would do that.
Okay, sir. Thank you so much. That'll be all from my side. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Nitin Gandhi from InnoQuest Advisors. Please go ahead.
Yeah, thanks for taking my question. Can you just more elaborate on phase 2 of the expansion, when will it go commission, and how much amount we have spent for phase 1 and phase 2 likely to be? And when do you see phase 2 capacity to start revenue contribution, and how much will it be? Thank you.
So as we mentioned in our presentation, the Dahej project was approved by the board in August 2025, and we have started construction for the same, and the total project outlay would be 100 crores. Phase 1 would be starting in H1 FY27. We expect the second phase to start probably in a couple of years post the commissioning of phase 1, because as a prudent allocator of capital, we like to slowly deploy our capital as and when we see the utilization levels reaching a level which is, where it makes it necessary for us to, press the pedal and expand further. So I would say the approximate timeline would be H1 FY27 for phase 1 and about 2 to 2.5 years thereon for phase 2. And the total revenue potential from this investment would be in the range of about 900 crores for both the phases put together. Just to point out one more thing, that even after the two phases are commissioned, there will be sufficient land available in the Dahej facility for exploring newer areas of growth which the company is currently working on. As Mr. Anirudh mentioned that we are working on recycled rubber products. If as and when the project gets commissioned in South India, and if we need to expand our presence for the same in Western India as well, which could be the case because of proximity to the tire industry in Western India as well, that project would also get expanded in Dahej.
Okay. So both phases will be equal contribution, right? 450 crore each, right?
Roughly, and give or take 10% because the product mix is slightly different. Yeah.
Right.
So more or less, yeah.
And amount spent will be how much when you capitalize phase 1?
So you see the amount spent already for the land, etc. is about 25-26 crores. So the balance would be more or less, on the incremental spend, more or less it will be 50-50, more or less. Maybe in the first phase there could be a little more because of certain utilities, etc., which would be front-ended, which will be used for the ensuing phases as well.
Fine. So maybe 60-40 is generally we can take.
Yeah, maybe.
Okay. And any probability of increasing margin? You said 11 to 13 will happen with phase 1. So with phase 2, are there likely to be some scenario indication if you can share what's in your mind?
So, as you mentioned before also, as the economy grows, as we are getting new and new consumption centers, in the sense that apart from the rubber, tire, ceramics, there are newer applications coming, as we mentioned about healthcare, personal care, then the battery segment, then other specialty chemicals, and also some other electronic industry. So these industries obviously consume a much higher quality of zinc oxide, where the competition is less and the ability to manufacture is also limited to a few producers. So as and when the market for this expands, which we said, we are trying to grow our non-rubber participation from approximately 15% to 30%. These kind of supplies obviously have a much higher EBITDA margin, and the blended EBITDA with these kind of margins growing would obviously be higher, and that's why we said that we expect the 11% to grow not 11%.
This 15 to 30 will take approximately 3 years or 4 years, right?
Yeah, 3 to 4 years.
Yeah. Okay. Thanks a lot.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Dheeraj Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. So my question is on the zinc sulfate side. So in Q2, what was our performance on a YY basis, and also what is the outlook on the zinc sulfate going ahead?
So on a YY basis, the zinc sulfate revenues have recorded an increase, and we expect that zinc sulfate would also continue to grow and help our de-risking strategy of increasing the contribution of the agri segment also going forward. The demand for zinc sulfate is gradually increasing across several areas, whether it's animal feed applications, micronutrients, fertilizer applications. So this is a business which is a good business for us because we have certain strengths in terms of raw material sourcing capabilities and integration and alignment with our core business of zinc oxide. So I think this is a good area where the company has invested in, and we see that this segment will continue to grow going forward.
If you can quantify in terms of numbers, so what kind of growth we have seen in the zinc sulfate particularly? Because Q2 being the agri kind of a demand that we see because of monsoon, so what kind of growth we have registered in the zinc sulfate business particularly?
So zinc sulfate, so you see there is in South India where we are located, the monsoon comes in different states at different periods. So the main demand comes actually in Q3, prima facie, because this is the time of the year when most states require the zinc sulfate. So on a year-on-year basis, on a half-year basis, the company has recorded more than 20% growth in revenues in the zinc sulfate segment.
Okay. And sir, in terms of zinc oxide side, what was the overall growth that we have seen in the volume side?
You're asking on the zinc oxide segment, volume growth?
Yes, sir. As you mentioned that we were running at 70% utilization. So for the quarter, what was the volume growth that we have registered?
So the volume growth on the zinc oxide segment was close to about 6 to 7% in first half of the year.
And in the Q2, sir?
I don't have the number of Q2 Y-on-Y right with me, but we can connect offline and I can share that with you.
Okay, sure, sir. And sir, on the recycling part, as you mentioned in the presentation, particularly rubber recycling, and this project is going to commence from Q4. So my question is, what kind of revenues and the margins we are expecting in the initial, let's say 1 to 2 years, and where we will source our raw material from?
Would you mind repeating your question once again, please?
So on the rubber recycling side, as you mentioned that we will start the trial project from Q4 FY26. So my question is, where we will source the raw material from first, and second is what kind of revenue and margins we are expecting from this segment, and what is the investment that we have done?
So, coming to your first question, the raw material sourcing. The raw material sourcing will be a mix of domestic tire scraps and also international imports. So it will be a mix of both depending on how the availability is and at what price point it is available. As far as the trials are concerned, yes, the trials will start from Q4. Currently, we have set up a pilot line for the same, and we will be working very closely with some of our established customers to develop grades for this recycled rubber, which tailor-make their requirements. So once these trials are established, then the commercial scale production would be undertaken, and that will, at due course, we will disclose to the market what is the exact project details for that. Currently, the pilot line is there, and the pilot line trials will begin in Q4.
And so currently, at what percentage, industry is using the recycled tires?
Sorry?
Currently, in the tire industry, what is the percentage usage of recycled tires, sir?
So currently, the industry mostly uses a product which is called reclaimed rubber, and this is different from what we are doing. Reclaimed rubber is a standard product which has been available in the market for the last maybe more than 2 to 3 decades. This, I believe that the tire industry is able to use roughly 3-4% at max, whereas the rubber that we are talking about, the recycled rubber that we are talking about, we are targeting a usage of close to about 15%.
Okay. And so lastly, on the export part, what was the contribution of export in the current quarter?
It is between about 12%.
This is for the H1 or Q2, sir?
H1. We're talking about H1.
Okay. And sir, in terms of margins, when you mentioned that our margins for the current quarter was 10.3%, but this is including the other income, right, sir?
The margin profile for the current quarter that I mentioned was 9.92, the EBITDA margin profile.
But this is including the other income. So when you mentioned 10 to 11%, this is including the other income.
Yes, it includes the other income because in our other income, there is also a good element of other operating income as well, which is clubbed as the other income. So yeah, it is including other income. You're right.
Okay, but sir, going forward, as you said that our raw material prices have started moving up, and this will be an advantage to us. So you feel that our margins will also start improving quarter after quarter, sir, as prices have started moving up on the commodity side.
This is something, the market can decipher for itself. I mean, we've always mentioned that obviously any movement in zinc prices affects the core inventory, which is a large part. So, I mean, the market is intelligent to understand that how this will affect us. We would not like to comment much on this.
Okay, sure. So that's it from my side. Thank you, sir.
Thank you. The next question is from the line of Divya Dave, an individual investor. Please go ahead.
Hello, am I audible?
Yes, ma'am.
Yeah, so I just wanted to, ask a few questions with respect to our global scrap sourcing. So I just wanted to understand how are these contracts arranged, in terms of the tenure and the arrangements of these contracts.
Yes. And any other questions? I can pick it up all together.
Yeah, and also, with respect to this shift towards higher performance tire and the adoption of EV, I just wanted to understand how is this impacting the demand for the zinc oxide from our end?
Okay. So as far as the first question is concerned, which is regarding international sourcing of scrap, these scraps are sourced from all over the world. There are different countries from which our material comes. These contracts are usually with, scrap yards all over the world and some from galvanizing plants which are also directly selling to us. Mostly this is on a relationship basis, and these relationships have been formed over the last 1.5 decades, because you must appreciate that people who sell scraps out of Europe, out of US, the transit times are long, they are very high value products, and it is also subject to the change in prices of zinc. So it is not only the price which matters. For them to sell scrap all the way to India, it is very important that they have a lot of trust and confidence on the company buying. And since JG has been buying scrap from them now over more than 15-20 years, and we've seen a lot of events in the world like the financial crisis, the COVID of the thing, and everything else, where prices have crashed, where facilities have been closed. But JG has always honored its commitment. So these scrap sales happen not merely on the pricing level, but it also happens a lot on the relationship and the credibility that the company has been able to build over a period of time. So we are very happy and very fortunate that our relationships with these suppliers are now some of them even more than a couple of decades old. And we continue to do more business with them as their sourcing capacity increases. And secondly, coming to your point of the high performance tire, so as far as zinc oxide is concerned, there is relatively no change whether you are manufacturing tires for EV, etc. I'm aware that certain other products have changed a little bit when going into EV tire production compared to the general truck bus radial of the regular tire. But as far as zinc oxide is concerned, it remains the same. And because our product is ESG compliant and we are making mostly out of scrap, hence the tire companies' agenda for using more recycled product also gets fulfilled with higher usage of zinc oxide.
All right, that's all from my end. Thank you.
Thank you. The next question is from the line of Deep Gandhi from iThought PMS. Please go ahead.
Yeah, hi sir, am I audible?
Yes.
Sure. So my first question is on the recycling project. So if you can explain more, is it a new product which you are trying for the first time in India, or is it already being used, by the rubber industry? If you can help us understand that.
So without disclosing much about this product at the current stage, I can only mention that this product is a relatively new product for the Indian market, but it is not that it has not been used, because this product is being made internationally and is being currently used by some of the large international tire companies. So let me keep it here for now.
Sure. So I mean, are the Indian tire companies also using it, or is it only the international companies and you are trying to build a market in India for it now?
So the Indian tire companies today are second to none. So they all are there with the latest technology, with the latest raw materials that are there for the offering. So yes, these companies have also had initial studies of this material. In fact, we have also got certain samples developed from our machinery suppliers, etc., and they have been tried by these companies, and the results are very encouraging for us.
Sure. And sir, as you were explaining that reclaimed rubber is already being used, so is this product like a competition to reclaimed rubber, or it is like used in a way along with the reclaimed rubber by the international players?
I would not say it's a direct competition to reclaimed rubber, because at the end of the day, the properties are very different, and the properties which the tire companies want to achieve by increasing the recycling content of rubber cannot be matched by reclaimed. To a certain extent, yes, it may substitute reclaimed, but I think the products are two different products, and the benefits that the product that we are going to make gives is far superior to the general reclaim which is available in the market today.
Sure. And pricing wise, is it like competitive to reclaimed rubber, or is it slightly expensive? Any sense on that?
So on a usage basis, the tire company would ultimately benefit by using it. I can say that for now.
Sure. And sir, can you share some timelines? I mean, the trials are going to start in Q4 as you mentioned, but how long usually do the tire companies take to approve the product? Is it like 6 months, 12 months, or is it even more? How does that process work?
So you see, the product that we're working on is it's something which is a win-win for both the tire company and us. Usually, as we mentioned, that the approvals in tire companies are very, very long, and it takes 4 to 5 years sometimes for approvals. But for this particular project that we are working on alongside some tire companies, we think that approvals should be fairly short, probably 6 to 9 months or so. And in some of the cases, it's more like a joint development. So it is not that it is a product that we are trying to offer to them. It is a product which we are working together. So that makes a lot of difference whether you are just as a supplier or you are more as a collaborator with them.
Sure. And sir, value-wise, I mean, can you give some sense, is this product like, can it contribute significantly to our revenue, say 15-20% of revenue few years down the line, or is it, like an ancillary product and you'll keep adding many such products which will, in a way, few years down the line start contributing significantly to the revenue? Any sense on that?
So this is a new age product. This is a product which the tire industry is looking for. There is increased pressure every day there is a pressure on the tire industry to increase their recyclable content. Wherever there is an opportunity to do that, the tire industry is more than willing to try it, do that, and expand on that. Green tires are going to be something of the future, and something like a green tire will even require a higher dosage of recyclable products. Even if you leave aside green tire, even the current tire, there are mandates which force them to use more and more recyclable content. So yes, the vision for this product is not like just another ancillary product for us. We think going forward in years to come, this product will also be a significant business for JG and would contribute handsomely to the revenues, etc. It's a product which is growing in demand in future. And with more and more trust on, ESG, recycling, etc., the future for this product is strong.
Sure. And so last question on this topic, and then I have one more question. So, as you mentioned that some of the global tire companies are already using this product, so I mean there will be global suppliers. So, what is what we are trying to do different? I mean, is it the cost that we are offering to the tire companies lower compared to the other suppliers, or how will we compete with the existing suppliers of this product?
So let me take you back to a little bit about tire manufacturing. Tire manufacturing is not the same for every company worldwide, and the same not for every company in India. Each one has a specialized recipe, and that is why we mentioned that it is not all about just supplying a product. It's about joint collaboration, joint development. So that is enough hint for you to understand that this is not a commodity product where you make a grade and everybody will use it. This will have typical customization which the foreign supplier, although there are not many of those anywhere in the world, but they would not be able to do that with the Indian tire companies on a case-to-case basis. There, our relationship, our long-standing relationship with them, our reach, our partnership with them will help us to develop this for them individualistically.
Sure. That was quite helpful. And so the next question is, if I look at the zinc prices, in FY23, zinc prices had corrected significantly, but yet we were able to hold on to our margins, and then in FY24, when the zinc prices were, comparatively stable, our margins had slightly corrected. So if you can explain what had happened during these 2 years.
So I'd like to take you back. The quarter is, FY20 June quarter 23 and September quarter 23, which is FY 2023-24, there was a very, very sharp drop in zinc prices of more than, I think, $700-800 in a span of probably 2 months or so. And we've always mentioned that, if there is a very, very sharp swing in prices of zinc, upward or downward, there could be an impact on our margins. But if the movement in zinc prices of the same quantum is over a longer period, that will not have much impact on our margins. So this is something which we have explained earlier also in our presentations which have been submitted to the stock exchanges and also in our previous Concall, that if the zinc prices were to behave normally, we have a set margin. If the zinc prices were to move abnormally up or down, it would have a short-term impact in our margin. But if the zinc prices were to be relatively, in a broader range over a longer period, that will not have much impact on our margins. So this is the basis this comment. If you see the numbers, it speaks for itself for the last financial year as well as this financial year.
Sure. And so just one last question. So you mentioned that usually you keep a core inventory which also has an impact on the margin. So can you tell us in terms of the inventory days, how many days of raw material do we usually keep in our books?
So our total working capital cycle, including finished goods and raw materials, is roughly about close to 90 days, 60 to 90 days, depending on how the situation is. So that's a broad idea for you.
Sure. So most of it would be the zinc inventory in this?
Sorry?
I'm trying to look at how many days of zinc inventory do you usually have in the books. So if I was saying your inventory days.
So whether it is finished goods or raw materials, both have a zinc content. So it doesn't matter whether it's in the form of finished goods or raw materials. It is both considered as a joint zinc inventory only. Roughly 2 months.
Oh, sure. Thank you. That's helpful.
Thank you. The next question is from the line of Nitin Gandhi from InnoQuest Advisors. Please go ahead.
Yeah, thanks for taking my question. You said right now we are operating at 70 and next year target is somewhere around 85. And that's the peak operative maximum revenue potential from existing. Am I right?
So yes, what you're saying is that once we reach 85% from the existing capacity, that's ideally the peak that we should do. But obviously, in the past, we have gone up to about 90-92%. If the need arises, we can definitely increase it to 92%. But I don't think there will be a need because by the time we reach that utilization phase, our Gujarat plant will definitely get started. And as we have mentioned earlier, we are also evaluating some brownfield opportunities and debottlenecking in our Naidupeta plant. As and when we feel that the capacities are getting fully sold out, it's a good problem to have, and we will do some debottlenecking to increase capacities in Naidupeta as well.
Okay, and this phase 1, when you start in H127, let's say by September 26, how does it revenue contribution start happening in H227 or years thereafter?
So you're asking about the revenue coming from the new project?
Yes, new project.
As we mentioned that the new project will cater to not only tire, but the bulk of the market will be ceramic and also other specialty chemicals, etc. In these segments, the approval process is not so long and it is fairly short. So we expect revenue to kick in much earlier than had it been only reserved for the tire business, much quicker than that.
So H227 could be operating at 40-50% of capacity or little more?
I mean, it is difficult to say, but H2 will definitely see revenue coming in. Whether it will be 40-50% or 30% that time will say, and it also depends on market conditions. But having said that, please keep in mind that the thrust of that plant will be to ceramics, pharma, and also specialty chemicals. Especially in specialty chemicals and ceramics, the approval times, lead times are not very long.
Okay. So, and how much time does it take to reach a peak capacity potential?
I mean, that should not be an issue for us because as far as the technology is concerned, it's a technology that we've already been running. So to get to peak capacity on the production side and on the sourcing side should not be an issue. It's mainly dependent on the market. As the market, receives the product and needs more of it, we will be able to scale up. That should not be a challenge for us.
So 28 is also possible in that case, right?
Sorry?
It's possible, quite possible in 28 as well, correct? It can happen.
What can happen in 28?
Operating at peak capacity of the new 40,000.
Yeah. If the need arises, we can get to peak capacity in very short time.
Okay. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Mohit from Shubh Labh Research. Please go ahead.
Hi, sir. Hope I'm audible.
Yes, please.
Yes. So my first question is based on ceramics. So the estimated demand for zinc oxide in ceramics market is around 25,000 to 30,000 tons per annum. If you can throw some light on what percentage market share are we covering now and what are we targeting after the commercialization of the Dahej plant?
So as we mentioned in the past, our share of business in the ceramic market is very, very low, less than 1% today because of lack of presence in the region. One of the reasons for choosing the location was to be close to the ceramic market, plus also close to the specialty chemical and the tire market, which is very big in Gujarat. Overall, the market share in India is over 30% on a consolidated basis. We expect that, once we enter the ceramic market in a couple of years' time, we should be looking at least 15 to 20% market share in that segment. And I think if we're able to get that, we'll be satisfied because we want to cater to the good niche and organized players in the ceramic market for now.
Okay, sir. And my second question is based on pharma business. So how is demand from pharma business? Like, if we estimate it is around 6,000 tons per annum. So is it good or we are facing some issues there?
So the pharma business and the high-end grades, this personal care, performance chemicals, this is a segment which is gradually increasing every year. Because you see, as the economy in India gets stronger and bigger and the purchasing power of each individual increases, the demand for higher-end products increases. So new markets and the total addressable markets in these, in this segment, it is getting higher and higher every year. And some of it has nothing to do with any seasonality of the product or anything. So this is an area which will continue to grow. Yes, whether it will grow 30%, 20% or 25%, I don't have a number on, which I can give you a guidance on. But we are very confident that this segment will continue to grow. Because newer applications are coming up in India, which did not exist earlier, but they definitely existed in the West. So as those products are getting consumed in India, as those products are getting produced in India, the demand for those products to get manufactured in India is also getting more and more, wherein we come in as a supplier of high-grade zinc oxide to them.
Okay, sir. Very comforting, very comforting. And so I know it is very early stage to ask this question, but the new venture that we are looking into recycling rubber, what kind of margin can we expect from that? Will it be in the range of 13 to 14% or would it be higher?
I think it's too early to comment on that right now because we are still working on certain, finer details of the project, and we would not like to share more details at this stage. Once we are ready with the project and ready to make a formal announcement, we'll definitely give you a rough estimate of the margin profile that we expect from that venture going ahead.
Okay, sir. Thank you. That's from my side.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
So, thank you. Thank you to Phillip Capital for organizing this. Thank you all the participants in this earnings conference call today. I sincerely thank you for joining this evening, and I hope we've been able to answer most of your questions satisfactorily and at the same time offer you some insights into our business. If you do have any other questions or you would like to know more about our company, please do reach out to our investor relations manager at Valorous Advisors, and they would be more than happy to share the details with you. Thank you once again for joining. Thank you. All the best.
On behalf of Phillip Capital PCT Desk, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.